Well, good afternoon, and welcome to the DD Talks panel discussion on the buyer's perspective around NPL transactions. My name is Alok, Gahrotra, and I head up the portfolio lead advisory team at Deloitte. It's a team primarily focused on non-core and non-performing loan transactions, working with banks, helping them buy and/or private equity on the buy side. Our recent focus post the GFC, while it's primarily been in Europe, we do have people based in Asia and South America providing global coverage for our clients. I'll probably take a couple of minutes to introduce the great panel that we have today and then dive straight into the discussion. Starting off with Marta. Marta Sanchez is a senior investment officer at IFC's Distressed Asset Recovery Program based out of Washington. She leads IFC's investments in distressed assets and special sits across Eastern Europe, Central Asia, and in India. Next up, Akis Bis is the Vice Chairman and Managing Director of Intrum Investments in Greece. He's responsible for the investments across the NPL portfolio and other investments in the Greek market, and was one of the lead negotiators for the conclusion of Intrum's landmark transaction with Piraeus Bank in Greece, creating the first mega servicer in the country. Konstantin is a managing director in the credit team and joined AnaCap from JP Morgan, where he was part of the principal investments team in New York and later London, focusing on whole loan portfolios, asset-backed lending, as well as servicing and origination platforms. We also have John Morris with us. John serves as the president of First Financial Network, the first asset sale advisory firm established in the industry way back in 1989. He is the lead business development and relationship manager for their international business and provides oversight for the US business. Last but not the least, we have Richard Roberts. Richard joined Arrow in 2017 and is responsible for portfolio origination and M&A for the global group and the 1.7 billion fund that they have. He has led the acquisitions of Mars Capital, Europa, Par Credit, and the other platforms that they've consolidated over the last couple of years. Thank you all for joining me on the panel discussion today. I think we'll get straight into it. From an NPL transactions perspective, we saw a very busy 2018-19. I think in the European context, we had deals in the 150 to 200 billion levels, and we've seen a significant drop off as a result of the current crisis and as it hit in early 2020. A good place for this discussion to start would be, how have you seen the market in the last year from a transaction flow perspective, and what do you think the outlook looks like? And I might ask Marta to start us off, and maybe for Konstantin to chip in.
Thank you, Alok, and thank you for inviting me for the panel, and also hi, everybody, and nice to see you all. So, Alok, I think from our perspective, as you know, IFC, we only invest in emerging markets, but globally, we saw that 2020 was a quieter market, but it really depended it really varied from market to market and region to region. So while we saw in Latin America transactions happening, especially in Brazil, Eastern Europe and Asia, and particularly in India, we did see a drop-off in transactions. And in terms of what we expect the outlook to be, we think that once the moratoriums and liquidity measures taken by government end in the next couple of months, we expect activity to resume in the second half of the year, and especially next year, 2022. And from an IFC perspective, we don't usually do one-off transactions. What we do, we set up facilities in the markets where we operate. So in those where we are already active, we are strengthening our position by setting up facility with new co-investors and servicers in new asset classes. And we are also positioning ourselves in new markets so that we are ready to deploy capital whenever activity really resumes.
Thank you. Konstantin, I don't know if you've got a perspective on this as well.
Yeah, definitely. Thank you, Alok. I very much echo these comments. I think we're coming off of a high as far as transaction volumes that you mentioned in 2018, in 19. I think last year certainly saw a shock to the system. What we experienced is that a number of transactions that were ongoing were put on hold. I think, the proverbial bid-ask gap opened up as there was a lot of uncertainty about what the future may look like. And as we've been working through that picture, I think what we've been seeing is that some transactions are taking place. We're selectively busy in jurisdictions. I think they're exclusively on legacy projects. And I can understand perfectly well why that is. In the conversations that I was having with a number of banks through last year, while previously the disposal of NPLs and the management of the balance sheet, the cleansing of the balance sheet was topical for a number of these guys, I think a number of agenda items were introduced at the top of that list, and they didn't have anything to do with resolving NPLs. I think they had to do with navigating the new landscape. I think they had to do with making sure that all these borrowers are getting access to the government, various forms of government guarantees. They had to do with figuring out a way to distinguish viable from non-viable companies in the current environment. So I expect that as the progress with vaccination and a relaxation of these measures progresses, we will start to see some of these discussions around balance sheet cleansing become move towards the top of the agenda again.
Perfect. And I think from my perspective as well, right, and any discussions we've had with banks, it's the legacy stuff that's being accelerated with. I think anything that's current crisis related probably still 12, 18 months away from necessarily coming to market. I think just, in the last, and we would have seen this in bank results over last year, there was a significant increase in provisioning levels and in migration of exposures from stage 1 to 2 to 3, primarily in the first couple of quarters and maybe even into quarter 3 last year. But from our perspective, I think the banks are probably still some time away from understanding full distress and the impact of the crisis. John, from your perspective, when do you think there's likely to be a pickup in transaction flow again, and for banks to fully understand what the level of distress as a result of the current crisis might be?
Yeah, great question. I agree with the panelists as well. So, the realization of where we're at is still ongoing. The progression of the vaccine and the government sector, what they do, politics is a huge play into all of this. It is in the U.S. for sure. As far as residential loan sales in the U.S., the moratoriums are still in place. There's extensions of those with the new administration. So our sales of residential product will probably drop off considerably in the U.S. We're a seller for Fannie Mae and Freddie Mac, the two big originators here in the U.S. Internationally, it's difficult to really put my hands around that, my arms around that. In Europe, we sold 2 portfolios last year for over about $1 billion. We had 2 sales that were canceled due to COVID in Western Europe, but we conducted 10 bulk sales in the U.S. It's a very active market in the U.S. Our systems and our platform is all in the cloud. We were able to conduct our transactions, and our buy side market was really, really strong. The C&I, the CRE loans sales were very strong. Pricing held up. The only real sectors that were weak, or we didn't take to market very often, were the hospitality and the consumer sections as well as a retail. So that's pretty much it. As far as globally goes, Latin America has picked up some. We have a lot of experience in Latin America. We've sold loans in over 30 countries, and we're seeing Latin America resurface here in terms of asset sales. I hope that Europe does as well. I think there's a number of groups, sellers on the sidelines right now that are dealing with this Konstantin legacy assets, as you said as well too, Alok. They did not clear from the crisis from 10 years ago, and they're still on their books. They need to move those forward. As we all know, we're in the NPL business, and we sell a lot of performing loans too as well. But with NPLs, there's only one trajectory, and that's down. They're only going to lose value. So taking that loss and moving forward is the way forward here to straighten up the economies throughout the world.
Okay, understood. Thank you. I guess just, apart from, banks getting their heads around level of distress and provisioning levels to be able to take that hit John just talked about, from a regulatory and a legal reform perspective, Akis, maybe I come to you. Do you see, changes on that front impacting transaction flow, impacting, banks' ability to take provisions, risk weights, etc. as well?
Yes, thanks for the question, Alok, and good afternoon, good morning, or good evening, depending on where you are and watching this panel speak. Absolutely, I would say it very much it takes for from an investor's perspective, to take that as an example, any legal or regulatory reform in a specific jurisdiction is something that is very, very important. Not only to facilitate a specific transaction, but also as well you acquire an asset, and depending on the multiplicity, if you will, or the different asset types with which what you engage in, it's very important to also establish the right servicing for that asset. So, of course, legal and regulatory the legal and regulatory infrastructure within jurisdiction very much is a key component to what an investor, and of course, in that respect, also the bank would also try to leverage that in order to initiate a sale. So if we take Greece as an example, and to see what has happened here in this particular country the last few years, but it's pretty much, I would say, following along the footsteps of what has happened in other jurisdictions where the NPL problem has arose in the past. We saw legislation, that would help, number one, the banks try to dispose assets sooner rather than later. A very specific example that is, that many of the investors are aware of with respect to the Greek market is the HAPS securitization scheme, or in other words, the Hercules asset protection scheme, very much following the lines of the GACS in Italy, which means that this specific action where the government is guaranteeing notes is something that is supporting and helping both the banks to divest, but also investors to invest. So that is something that I would put within this legal and regulatory environment. Another example is the what's so-called second chance bankruptcy law. Second chance bankruptcy law via another law that was introduced in the past, again in Greece, which was labeled more as a primary residence protection law, which created a lot of strategic defaulters to that. This new law now that is being in the works, and it will be implemented now in March. What that expects to do is, provide, in fact, a second chance to borrowers and debtors to fix their NPL problem, and of course, it gives also the ability to servicers to be able to separate the strategic defaulters from the persons who are in real hardship or in real need. So both from an investor perspective, but also from a servicing perspective, you see that that specific law that is about to be introduced is something that will be very helpful. So these are two examples in this market, but there are many other examples that one can use in its jurisdiction, depending on where that would be. That very much both investors, banks, and servicing units very much take into account, into consideration with respect to taking matters forward. So from an investor perspective, it certainly provides more of a I wouldn't say certainty, but definitely something that you would price into your valuation, and would certainly provide the level of comfort in order to enter a jurisdiction, buy the asset, and then assign it to servicer. So so definitely a key factor.
Perfect, thank you. And I guess, while you've mentioned HAPS in Greece, I think, in geographies and primarily Italy and Greece, we've seen these government-backed securitization programs play an important part in transaction flow in the last couple of years, right? So, GACS in Italy, HAPS in Greece. From an investor perspective, and maybe this is to the wider audience, right? What do you think this has done to the NPL investment market? From an advisor perspective, I see it, it at least on the advisory side, it's kind of destroyed that arm's length straight sale market with investors going in, especially with the platform carve-outs in Greece, right? Going in and looking at these transactions cumulatively and potentially with cross-subsidization happening across the platform versus the notes, and option value in certain cases in the mezz and the junior notes. But I don't know if Richard, you, Konstantin, or Akis, you have a view on some of these.
Well, I mean, I haven't done any. I mean, maybe Akis is a better person to comment on this, but we bought in the secondary. But the programs, which are government-backed, effectively GACS, etc., were there to improve the execution for banks which didn't have a lot of capital and couldn't take the losses from the true market value or the arm's length senior financing that was required. So some of the Italian banks just would not have been able to sell, or there would have been a lot of consolidation required if they'd mandated Deloitte and say, sell my 5 billion portfolio without a staple. So it facilitated the flow out of banks which were lightly capitalized. It moved some of the risk clearly onto the state, but the state could finance themselves cheaply. And it was a more politically acceptable way of moving NPLs than seeking bank consolidation or bank bailouts. So I think it was the right product at the right time. Did it go on a bit long? Maybe. Took Greece a bit longer than certain other countries, but certainly it's helpful in ensuring bank capital levels stay at right levels and assets move out. But yeah, it hasn't been a great trade for a lot of people that bought the mezz and the junior. I'm not sure if anyone else has a different view to that. Right product, wrong time. But right product.
Yeah,
I think.
Yeah, please, Konstantin, you go ahead.
I think Richard, you're absolutely right in that. I think it was necessary and it served its purpose. If I'll add something to that, is that obviously, we've said a couple of things about the, I guess, volume of transactions coming down in the last year or so. I think we should have probably qualified that by saying that the volume of primary transactions has come down, because what I guess what you were alluding to is most of these highly structured trades are underperforming right now, and the consequences of that underperformance are starting to bite. So what we have done, and we're not alone in this, is creating a machine that can start to pick small portfolios or single positions out of these transactions as they are trying to maintain their business plans. And that's an important, I guess, source of transactions, which are secondary trades in a way.
Yes, and I guess that's as a result of the current crisis as well, right? In terms of them just being behind plan, and also because of the delays on account of enforcement and courts.
I think generally the levered deals, forget GACS and Greece, and Akis should jump in because I'm probably speaking over him now, but across Europe, some of the levered deals from 2018-19 are going to be stressing 2020-21. So they'll be stressing against their IPDs. They will need to do sub-portfolio sales to AnaCap and Arrow and Intrum and the people that provide that liquidity. Lenders aren't going to want to step in and collapse these structures. They're going to encourage them to make asset sales. And unfortunately, I think some of the good assets will need to be sold. They won't be able to get rid of the real rubbish at this point. So there'll be a bit of a trade-off of what is sold. But unless you've got a very lenient bank, you're going to, some of these heavily levered deals with aggressive business plans and sub-performing services are going to need to sell assets.
Yeah, no, absolutely.
Yeah, what I just wanted to add is what's interesting is that what's happening here in Greece for the last year, or at least for the last, say, 2 quarters last year, and what's happening this year, and what's expected in the pipeline, it's mainly HAPS transactions. That's what all the banks are doing. So it is a way also to accelerate, right? So all the things that Richard mentioned earlier as to why do this, right? But it's also a way to accelerate, the deal flow in the country, and all of these transactions are huge. All of these portfolios are being, put under. We're talking about, for example, if we look at Frontier, which is the National Bank of Greece, it's a 9 billion portfolio. Vega from Piraeus is a 5 billion portfolio. So these are all, very huge portfolios that the Greek banks are trying to, of course, feeling the pressure also from the SSM to deleverage, right? They have to go through this mechanism to deleverage as quickly as possible. A lot of good work has been done in Greece for the last few years. Back in 2000, when was it, 16, 17, NPLs were at 107 billion. Now it's down to 57 billion. So half of the way there and decreasing, and in the hopes of, decreasing by much also this year, next year. But all the deals that you hear about now in Greece, it's all relating to house. You don't have anything else. Maybe, one deal closing here and there, but really deals coming down the pipeline. It's mostly house related to house.
No, okay, thank you. And I guess, to Richard's point, right? Like it was needed, and I think in the Greek context, with the current crisis, the Bank of Greece has come out saying there's potentially a 4 to 11% increase in NPLs expected, and so some of this goes back, and you're still struggling with the stock from post the GFC. There's been talk, I guess, in Greece of a bad bank as well recently. I don't know how developed that is, Akis, or if you've got a view, because I think in at least certain countries, and Greece is probably one of them, where it might make sense.
Yeah, well, there's been a lot of talk about bad bank, and it's been on and off in Greece, for several years. Of course, that was, again, it took sort of, it sort of picked up again in the last few months, especially towards the latter part of last year. It's been supported, I would say, by some, non-supported by others. It became a little bit of a political play as well. I think that both from an investor and servicing perspective in the Greek market, I think that a bad bank could offer a solution. Of course, there's two different schools of thought here. One is around the bad bank providing a solution for deleveraging very, very quickly. The other school of thought is around continuing to implement HAPs, and that introduction of a bad bank is really not necessary. So far, what I can say is that HAPs has been working out well. Banks have committed to it. Investors are very much participating into the processes, and there's a lot of interest as well. It's not, it's huge interest by investors, which is, especially now during the COVID times, it's really surprising, to be quite honest, as well. But it's there and it's happening. So an introduction of a bad bank at this stage in time, one can wonder what is the value add at this time, right? Given what HAPS has provided, and there's a HAPS 2 as well coming down the pipeline that is being proposed by the Greek government. But if one can identify the specific value add to a bad bank, I think both investors and the servicers are all very open to it and ready to ascribe to it, if you will. In some, and also there's a little bit of a connection of having a pan-European bad bank as well. So take that to the next level, because it's not only a Greek matter, right? It's it's more of a European matter as well. And I believe that what bad bank talk has been here in Greece, and mostly supported by the Bank of Greece in terms of its introduction. It also tries to follow along some of the European footsteps in that respect. But maybe one size does not fit all, right? It could be that some jurisdictions may require bad banks, and some other jurisdictions may not. As I said earlier, HAPS is something that has worked well in Greece and continues to do so. So remains to be seen. But right now, there is no. With respect to the bank, there is nothing that I could say that it's really tangible to see that it's coming, right? It's still a discussion. It's a topic that's being reviewed and discussed, but nothing firm that it's going to be implemented.
No, understood. Thank you. And I guess just going back to the limited transaction activity that we have seen over the last year, but we did see some stuff close. And I guess to Konstantin's point, this was, probably stuff that was legacy, already in train, got relaunched, second half of last year, and we saw it close. Just from your perspective, in terms of deals that you've looked at and closed in the last 6-12 months, what changes have you seen from a pricing, transaction structure and/or asset class perspective? And this is probably maybe Konstantin, I get you to start off, and then Richard and Marta can jump in.
Sure, definitely. I think a few interesting observations, right? We have seen that actually our own appetite and our funders' appetite for performing assets in that period has grown, and that probably underlies the stability that certain assets, performing mortgages, reperforming mortgages, just straight runoff portfolios have shown through COVID and through other times. So that's been a focus of ours. And the one change that we've seen actually has been that the banks that typically fund these types of acquisitions, providing senior leverage, have become very, very keen to continue to do that. That's probably a result of fewer NPL volumes where they were historically more active as well. I think it also comes down to capital efficiency, because many of these things can be structured such that the risk weights that lenders hold against those positions are minimized. So that's one change that is very live for us and we're benefiting from. Something else that I've noticed more on the asset side and then the structuring side, I think this has also been widely reported, is that increasingly I'm seeing flexibility from sellers in working with price deferrals or contingent prices or mechanisms like that to resolve the big unknowns in specific portfolios. I think this first started in Cyprus, where some of these structures have been reported on, but increasingly, we're finding that actually people agree that certain things, we don't know how they'll play out, and there is a way, however, to structure a mechanism to make sure that if things play out better than people expected, obviously the sellers aren't penalized for that. So I think those structures are coming back, and I think this is mainly a result, again, of probably a concerted push by auditors and accountants to let sellers get away with recognition on these mechanics.
Richard?
I agree with most of what Konstantin said. I'll take Konstantin's last point and then I'll come back to your question. We found it more difficult actually at the moment with banks and non-bank sellers to push for earnouts or bridging bid-ask gaps. We find the fact that there's less tolerance, and with so many people chasing deals, unless you're very off-market and bilateral, there's always someone who's willing to pay up front, which is what they want. They just want a clean separation. Because I think many sellers have been burnt by earnouts by less reputable firms than those on this call. So I thought, if anything, finance departments have become more cautious on those kind of things, and advisors clearly want payment upfront because it maximizes their fee. To the original question, that we started investing our 1.7 billion fund last January. We've done 40 deals. Now, clearly, some of our deal sizes aren't as big as many of our competitors, but clearly we've seen decent deal flow over the last 15 months. I think we originally thought we'd be investing off our 14 platforms that we own into a broader range of asset classes. In reality, we've gone much narrower than we expected because we focused on shorter WAL, we focused more on asset-backed versus unsecured consumer. We went for asset classes where court and reg risk were less prevalent. So we didn't want to take risks that the FCA would restrict your ability to collect from unsecured consumers or mortgage NPL mortgages would be more difficult in Ireland because of reg changes. So we tended to focus more on bankruptcy, insolvency, where the loss event had already occurred, where the court risk could be assessed. Cash in court, where literally it was just a question of could you get enough credits in a bankruptcy to get the distribution to occur, and if you can accumulate enough, you can make a difference. But generally, I think there's more across the market and more focus on secured assets than there were unsecured, because unsecured assets, broadly consumer, the banks and the non-bank lenders just don't want that customer journey to end at this point. And because they're all well capitalized and none of them really need liquidity at this point, apart from maybe in April, May, they just don't need to sell the consumer risk. The one thing about unsecured consumer, I'll just give an example in the UK, if a bank launches an unsecured consumer portfolio sale, you will find typically 9 people will run at that very hard, because of those 9, 4, 5, 6 of them, all they do is unsecured consumer. And if they're not buying that unsecured paper, they don't really have a business. So it plays much better to people like, again, I'll pick on AnaCap and Intrum as examples, people who play in multiple country, multiple different asset class, who can say, I see value there, therefore I'm going to go it, but I don't see value there, therefore I toggle it away. The monolines who just have to do deals effectively are restraining the ability for pricing to improve for NPL buyers. There's a lot of money out there, and at the moment there aren't enough transactions that the returns are, in my view, in certain asset classes, increasing enough for the risk.
Yeah, you have to keep the machine running, I guess. No, and I guess to Konstantin's point, and just coming back to one of the comments, right? Like we've seen those structured deals, I guess maybe in Cyprus and in Greece a little bit, but you know, at least from my perspective, it was where the bank was, you know, reasonably heavily pregnant with the transactions, and it was a way to almost saying, okay, headline price kind of stays the same and keep it there because that's the market. You know, that's what we need to message to the market. But
I'd love you to do a seminar in 6 or 12 months' time, Alok, which says I'm going to show 3 or 5 examples of earnout or bridge or some kind of deferred element and how they went. I'd love there to be a body of work that we can walk into the CFOs or the treasurers at some of these banks and say, look, this is really happening. And it actually worked out well for the seller because everyone behaved themselves and there was an aligned incentive. Because we're all structuring guys here, right? Guys and gals. We all think this is a good thing. It's just difficult to stick.
Yeah. And
unless
I think
Konstantin is so smooth and so able to communicate these things in a way I can't.
Yeah, well, yeah. I think we'd like it to stay, but I'm not sure it's, you know, it's here for the longer term.
I'd love to come back and do that in a year.
Yeah, Marta, I don't know if you've seen from your experience, what are you seeing?
So I guess since we only operate in emerging markets, we don't see 9 or 10 players bidding for the portfolios or for the assets that we operate. So I guess that in a sense is good, less competition. So what we have seen in the markets where we operate, for those transactions that really traded, we were able to negotiate lower entry prices, and mostly because, as Konstantin was mentioning, all this uncertainty that we couldn't price, and also because most of the deals that started as a competitive process move on to being a bilateral deal because many of these players pull off. And also to Konstantin's point, we have also been able to negotiate as with these lower entry prices, we were able to convince the sellers, bank and non-banks, look, I'll pay you less now, but if this really performs as expected, we will share the upside down the road. We saw a few instances in which we're able to have such a structure that maybe before we wouldn't have been able to because of, again, less uncertainty. And so you are able to price the portfolio or the investments better, and also because of more competition.
Doesn't sound like you're in a bad place.
You just need to have the appetite to go to some of these markets.
I think just, following on from that, right? So what's been the impact on your current investments, right? Like talking to investors, we hear there's been, and I guess you guys talked about this, right? Like challenges around the business plan. There's been timing delays. There's been, just liquidity issues, etc. So what's been the impact on your current investments across the board? I don't know, maybe Richard, you start us off, and what's keeping you awake at night on your current book?
We have 2 books really. The fund that we started investing last January, and broadly because it hit the themes that I was talking about, short while, no consumer, asset backed, Cash in court, it's doing fine. It's ahead of plan. We're very happy. If you think about Arrow's 1.5 billion or 2 billion ERC back book, it amortizes daily, so it's not lumpy. So collections are far better than we expected. We'll come up with our public earnings numbers in a couple of weeks. I think where you've seen Northern Europe hold up pretty well. Ireland's been a bit slower than we'd expected. Southern Europe real estate has been slower. So for us, front book's very good. Back book will obviously declare in a couple of weeks what's going on, but broadly it's been pretty good. What keeps me up at night is consumer risk. At the moment, we have none of it in our front book. We do in our back book. And all it takes is a socialist party or a government seeking to lean on vulture funds or whatever, and it becomes much more difficult to enforce on whether it's a mortgage or a consumer loan. So that's the thing that probably keeps us a little bit up at night. We also want to see the commercial office space come back soon, because I think if that continues, I think there's just broader issues across the whole market. It's such a big space.
Yeah, no, I think we probably see some structural changes there. Marta, from your perspective?
Yeah, so I would differentiate between of our current portfolio, the investments that we made pre-COVID and the investments we made during COVID. So I guess pre-COVID also depends on the jurisdiction, but especially in Eastern Europe, we have seen delays in collections that will certainly impact the IRR. We are hoping that not so much the multiple and that we can recover those collections. But yeah, certainly courts being closed, travel restrictions didn't help, especially for some certain collaterals of these NPLs. So that would be and I guess this is what keeping us at night, no? That we are able to realize the business plan, or at least not being very far off the original business plan. And going to my previous point, investments that we have made during COVID, I guess we were able to price them even more cautiously, so lower entry prices. So we have a buffer, and we priced in the uncertainty, no? So hopefully with that buffer and potential upsides that we didn't price, we are able to realize the business plan. But I guess we will see. We are hopeful that things will improve, but I think we don't know yet for sure.
Okay, Konstantin, anything from you?
I mean, look, I very much echo these comments. I think a few things became clear for us in sort of half year in our kind of half year exercise to remark everything that we manage. We took a very harsh view of what can happen, and actually the way it worked out is that we have outperformed that view significantly, right? So it's and that outperformance has come through a number of channels, right? We saw certain elements of the recovery actually accelerate, where others were materially pushed back. I think some of the delays around selling real estate, sometimes as a result of that market being shut, in terms of needing to find a notary who's open and working or allowed to work at that time, that was a challenge, and that's leading to delays across the board. Interestingly, in many of the places where we have such exposure, actually we've seen very positive real asset price appreciation over the year, right? So it's actually not necessarily certain that we've lost that much, but we've lost timing, right? So that's one consideration that we're playing around with. What we saw an acceleration in, I think Richard mentioned this, is cash in court, because suddenly the thing that's usually bottom of the pile for many judges, working from home, that's something that they could resolve, and they didn't need the input of many other parties. So we saw a big acceleration in that, right? But that's like a once in that particular exposure type opportunity, right? So most of that has been exhausted. So you're not going to get a further acceleration of that to the extent we experience another bout of like strictness in terms of the measures. So it's been a mixed bag like this. Actually, interestingly, to the extent that probably half of our book is non-distress, so not NPLs, we've seen very resilient performance there. And I think I would probably attribute that to the unprecedented government action, right? Not that many people have lost their jobs, and actually savings rates in the UK, in most of Europe, in Italy, are up in that period of time. So we've actually seen people clearing their debts, which has led to much better performance in our performing books. And you can see that in various securitizations as well, that's coming through. What keeps me up at night is I think Richard alluded to that, like, are we going to face a reg event at some point? Because debt is going up, and everyone's sort of pretending that there isn't a lot of distress in the economy. There are many non-viable companies, and unfortunately, there are many individuals who will go through a very tough time once that extraordinary stimulus starts to be withdrawn. Whether that goes with some other measures to protect them is something that needs serious consideration.
Absolutely. And I think, again, it's depends on geography, right? I think in certain places, obviously government programs have been wider, and so the support's been that much more, and the level of distress that you'll probably see at the end will be not as significant. I think just on that point, right? Like, Akis, I guess given you were the first, you did the first platform transaction in Greece, how is that working out from a business plan perspective, given it's probably coming up to a couple of years? And how is that different from a couple of the recent transactions that you've done with Piraeus and other stuff in the local market?
Well, I'll tell you, it's worked out quite well. I would say we're very happy so far in terms of the returns that we're getting, both from the servicing platform, but also from the portfolio investments that we've done in Greece as well. Of course, there is your ups and downs in terms of performance. Of course, there's COVID last year and this year, especially last year when the first wave came through, that created a scare for everyone, if you will, and we saw that also in the numbers taking a dive. But the recovery was smooth and even higher than we were expecting, to be quite honest, because we were quite conservative once we saw that we were being heavily impacted in terms of collections and the returns we were getting from the portfolios, and also some of the servicing revenue as well. But recovery has been nice and smooth, and I think this is also very much attributed from consumers, borrowers, really. So some of the money that they earn, not going into say entertainment, travel, and things, and taking and paying off that old debt, right? And finding good deals in doing that, restructuring or some DPOs or what have you. But also at the same time, you also so you see a good performance on debt levels, but also you see a good performance in terms of deposits. The banks also have, at least here in Greece, what we have seen is that bank deposits have increased over the last several months and from the COVID outbreak. So hence it's a shift of where the money is, basically. Of course, this is not something that is prolonged, right? Or something that can be prolonged. Or some of the benefits that one might get out of this, because a prolonged COVID situation, which right now we're seeing that, right, will eventually take its toll on the economy, which it has already, but it will eventually take a bigger toll on the economy, and you will eventually see that reflected in the numbers. But so far, I would say, so far so good. So as long as we can get vaccinations out there, taking place, accelerating those and seeing the light at the end of the tunnel, I think we might have a near miss here and not get into too much trouble. So that's a little bit of the perspective. But overall, quite happy in Greece, and we continue to be quite active and continue to look forward to further investments. So yeah, both the platform and the portfolio investments that we have performed are working out well.
Perfect. Fingers crossed. I guess, John, coming back to you, right? There's been a lot of talk, at the European level around NPL platforms, where even currently in the process of doing a study for the ADB around, NPL platforms in Asia. So what role do you think these play in the resolution, and especially given, where we already have an overhang of NPLs from the financial crisis, and then going into the current crisis, there'll be another build-up. So it'll be good to get your views on that.
Certainly, absolutely. So with the pandemic, obviously it's changed the way the world has conducted business, and that's not going away. There'll be permanent, even when the vaccine is throughout the world here, there'll still be permanent changes. The way we're all conducting business today, all 6 of us are at home, we're either at home or back and forth or offices to some extent. So having an online platform is absolutely critical in terms of moving assets. We were formed 30 years ago, in response to a banking savings loan crisis. We've been through 5 different US and global crises. We've been through the transitions. We began to form our online platform 20 years ago, and we've conducted all of our transactions online for the last 15 years. That is the only way to go. It's the only way to maximize the return to sellers. FFN only represents sellers, and I know the buy side likes their own deals. They like one-on-one deals. They don't like competition. Clearly they don't. But the sell side, they need competition to drive prices. And they need that platform in order to put out the assets they have for due diligence, for all the investor due diligence that the buy side needs, and for bidding platforms to maximize the returns. It's the only way to go. And again, we've been doing it for a long time. We've been doing it in Eastern Europe here more recently. We had 2 transactions scheduled in Southern Europe that one was actually canceled because the evaluations we performed for the bank institution were much lower than what they had anticipated. And so it was a waste of time to take it to the market. The other one was canceled because of COVID. But clearly, in Latin America, in Europe, in Asia, they needed to adopt to the online platforms. The days of the club deals and going to giant war rooms is over. It's been over, quite frankly, in the US for a long time. And the adoption of that in Europe needs to take place in order to efficiently move the assets for the sellers, maximize the returns. And for the investor side, for you guys that are the investors here, it's the only way to conduct business currently. You can do it online, and it is the way forward.
Yeah, I think, obviously as advisors, we see a bunch of, the stuff is online anyways, right, in terms of data rooms, etc. But I think from an actual online platform perspective, right, like there are probably certain asset classes that lend themselves more to an online setting than not. And then also on the prep side, when you're working with the banks, I don't know if you find a difference between your operations in the US versus what you encounter in Europe.
Much more competitive in the US. For instance, we're a private sector bank transaction, let's say it's 200 million. We may divide it up into 40 or 50 different pools, and we'll have several hundred investors that are qualified, vetted investors, legitimate investors that are coming into those transactions to perform due diligence. From that, we may have 50 to 75 different bidders. So we're maximizing return to the seller. In the US, there's been a number of banks that have moved forward with transactions here more recently in this last year, anticipation of the COVID crisis. The US government sector is a little bit far behind that. Fannie Mae and Freddie Mac curtailed most of their transactions. The FDIC, of course, is reliant upon failed banks, and they're preparing now for what is anticipated to perhaps be a pandemic here in the US in terms of, not pandemic, but a financial crisis in the US. The terms of Europe, where they go, they've got such an overhang of legacy assets. They're just bogging down their system. They need to clear those and move forward.
But do you find that it's easy enough to get the right information from bank legacy systems, et cetera, onto a platform reasonably quickly, easily, to be able to make that transition?
It is now. A long time ago, it was very, very difficult. We came up with screen scraping to provide data and so forth, but now it's much easier to grab the data and securely put it online. As far as the due diligence information, we perform extensive due diligence and provide that to the investors. asset summary reports, valuations to our sellers. All that work is taking place online. And that's critical to the deal flow.
Okay, no, that's good to know. Just, I guess, we've talked a lot about portfolio trades. Obviously it's only one aspect of things. We're obviously, and from an investor perspective, you guys are obviously seeing single ticket sales. Konstantin, you mentioned that as business plans underperform, you'll start to see acceleration of secondary stuff and potentially of even low-hanging fruit and good assets come to market. So what are you seeing from a going forward, I guess, for the next 12 months from a transaction flow perspective? You think it's NPL books, it's these secondary single ticket sales that come to market, or reperforming books, or what's the outlook looking like from your perspective? Konstantin, maybe you get us started.
Yeah, sure. Look, I think the NPL market as it used to be with similar volumes will come back. I think a lot of NPLs are being created. That's not just in the UK. That's across Europe. It's probably across all the world. So there is the stress in the system. It will eventually filter down to defaults on loans. Be those consumer loans, SME loans, corporate loans. We've sort of started to see it in corporate loans, and it went away because that the liquidity that's out there in the system swept that. I think it's difficult to say when that event happens. Obviously, as you were talking earlier, it needs to first go through the different provisioning stages. It will probably take a catalyst event like the unwinding of the support that banks are getting from the regulators as far as recognition of provisions on moratoria loans, as far as relaxing their countercyclical buffers, all these things. Once these elements are tightened, I'm confident that the NPL market will come back in full swing, because having that volume of NPLs continues to be very inefficient, for lenders. I think in the meantime, what we're finding a lot of success with, but again, it depends on the type of firm that you are. We are finding a lot of transactions to do that are not necessarily straight up coming from the banks. Examples of that are, as I said, loans that come from these essentially securitized structures, as they need to catch up with their business plans, because if they don't, all sorts of trigger events happen and servicers can change, et cetera, et cetera. So for the time being, there's a wave of these, and I think as they go into more distress, which has been happening, expect that to continue. There are a few other trends that I'm seeing, and I'm making sure we tap into. There are a lot of securitizations in Europe of various asset classes, and these things are coming up to call dates. Some have missed their call dates, so it's very interesting to see, and we've done it a couple of times already, to say let's get enough of the junior class in that equity to be able to collapse that securitization, grab the assets, relever them properly. There's a lot in that trade, and the fact that the equity is reasonably delevered after 5 or 6 years time is the key enabler of that transaction. We're very keen to continue to do these types of trades.
Makes sense. Marta, from your perspective?
Yeah, I think it will really depend on the jurisdiction. And from an IRC perspective, we cannot take an opportunistic approach. As you know, we need to make money on our investments, but we also have a development mandate. So we have rather a programmatic approach that is based on the strategy for that country. So I don't think for us it will change dramatically in the short term. We will keep investing in the jurisdictions that we are active, obviously subject to being trades and being there a flow. But as I was saying before at the beginning of the discussion, we are setting up platforms in new jurisdictions in Africa, Asia, Europe, to be ready for the flow when it comes. And in terms of asset class that you were also asking, again, for us, it depends on the jurisdiction, but we are an investor that invests across from NPL, retail, unsecured retail, NPL portfolios, all the way to single assets. So we will actively look for those that are most attractive in the jurisdictions that we can operate.
I'll give you two things that we're doing, one in our servicing business and one in the investing business. So our servicing business manages about 65 billion of AUM, where we're looking at big portfolios where the seller doesn't want to sell, but realizes that people such as ourselves can collect better than them. They are moving servicing to us. Now, they may be existing sponsors who are unhappy with their services. They could be banks, they could be non-bank lenders, they could be retailers with lending portfolios. They're moving portfolios to effectively collections experts who give them a bit of an arm's length deniability as well as cheaper costs, more flexibility. And the more assets we have on our platform, the more effectively opportunities we have to bid them at a future point in time. Okay, because effectively it's a walled garden where they're unlikely to leave our platform. They will maybe amortize over time and collect, which is great for the client, and we get servicing fees. But at some point, the client says, you know what, why don't you just take them off our hands? They're not going to ring one of our competitors. So that building up that AMS business is super important to our franchise, similar to what Intrum does, really. I think the second thing is, because there are so many people chasing deals at the moment, there's clearly more catchers than there are pitchers at the moment. What we're doing is we're setting up things we call aggregation vehicles. So instead of trying to buy a portfolio of 100 million, what we do is we set up a group of people, we own it, we fund it, and they try and buy 100 assets worth 1 million each. So it could be bankruptcy claims, it could be insolvency claims, it could be houses for PRS, it could be RIOs, it could be whatever. And you effectively, instead of going 100 down to 0, you go 0 to 100, and then you can either run it off or you sell it to somebody else with a cheaper cost of capital. Whether it's an insurance company, a pension fund, you can securitize it. But because we own 14 platforms and we're in 5 countries, which we know and like, you can aggregate at a granular level. So you effectively buy it commercial, you sell it retail effectively. So they're two things we're doing.
No, makes sense.
Effectively reducing dependence on formal sale processes.
Throwing us out of business. That's
yeah.
Akis. No, I know. Anything from your perspective, Akis, in terms of how you see the market going forward?
Yeah, I would say a little bit of what all of the Rachel, Konstantin, Marta just said earlier. A little bit of all of that. I very much agree with the comments. For us as Intrum, I would say that we maintain what I would call investor resilience. We operate in 24 different markets. In each different market, well, across Europe, that is, in each market, we will find opportunities based on various asset class, big, small opportunities, depending on what that might be. The 3 markets where there's a lot of action or activity that's been happening during the last few years has been Italy, Spain, and Greece, and hence we have as our strategic markets, given our investment exposure in those markets, but the size of the businesses, of course, as well. But I think it very much needs to be very, it very much depends on the market and the opportunities that are presented. And I think you have to be resilient from an investor perspective to be able to really focus, prioritize, and really get yourself in where you think you'll get the bigger bang for the buck, if you will.
No, so I think we're coming up to an hour. So clearly there is an opportunity, and I think we're entering a new cycle. There should be enough for us to do for the next 3 to 5 years. Obviously, a little bit different to what we saw in the last crisis, but clearly all of you seem to be placing yourselves well to take advantage of that opportunity as it comes through. But thank you all for taking the time today and for what was a great conversation. Hopefully we'll get to catch up in person at some point in the near future as things normalize.